It is so important to build a healthy and solid relationship with money as a young adult because those good habits can possibly carry throughout your entire life. So today we're going to look at a few important things to do with your money sooner rather than later. But before jumping in, this video is sponsored by Lemonade and we will talk more about them in a moment. So the first thing you need to do is recognize that your parents might not have set the best example when it comes to money. As a disclaimer, I feel that my parents did a good job in this area. That doesn't mean they got it right all the time, but I feel a lot of their advice was spot on. However, this is an unfortunate reality that a lot of people face. Now, I'm not saying that everything that they told you about money was wrong or that any of it was wrong for that matter. But what I am saying is that I have heard plenty of stories of people complaining about getting bad advice from their parents, but not realizing that that money advice was bad until it was too late. Do a Google search for worst money advice given by parents, and you'll have reading material for hours. So this type of stuff does happen, and we have to accept that some of what we've been told or taught about money isn't always correct. Our parents' relationship with money can have a positive or a negative impact on us because we often imitate what we see. So the way they manage their finances might be how we manage ours. So you have to be honest with yourself. Do you think that your parents are good with money? And if you answer no, or if you don't know how to answer that question, take what they tell you with a grain of salt and do your own research. In addition, you should try and make student loan payments while you're still in school. Unfortunately, a lot of parents are not in a position to pay for their child's education after high school. So for a lot of people, in order to go to a community college or trade school or a university, they have to apply for a student loan. But as we know, these can create a huge burden after finishing school. And obviously, there are ways to lower the cost, such as starting off at a community college, going to a state school, or maybe studying a trade. But even if you do all this, you might still need to get a loan. And with federal student loans, repayment doesn't typically start until after you finish school. However, if you're in a position to, meaning you're working and you have income, one thing you might consider is making in-school payments, which can include making smaller payments or interest payments. That way, what you owe at the end can be lower. It's also important to save at least 5% of your income. During the early adult years, some people delay saving because they can't do a lot or they feel they don't earn enough money. However, the longer you put off saving money, the harder it can become to start because as time moves on, you're likely to take on additional financial responsibilities. And once this happens, it can feel as if you don't have extra money. And the best way to avoid this is to start a savings routine early so that it becomes second nature. And even if you can't do a lot right away, something is better than nothing. And one thing you might do is start with maybe 2% to 3% of your income for retirement, and then start with 5% of your after-tax income for personal goals, and then increase this as your income allows. It's also important to buy renter's insurance. Now, obviously, I can't speak for every young adult, but just looking back on my own experience when I was starting out, other than health and auto, insurance was not on my radar. I wasn't thinking about life insurance, and I definitely was not thinking about renter's insurance. In fact, it was about 2 years into renting before I realized the importance of having a policy, and I only realized this after there was an apartment fire in my local area, and one of the news reporters said that a good number of the tenants did not have a policy. Before that, I assumed, and I don't know why, but I assumed that the landlord's policy would cover my personal items, but it doesn't work that way. And if my young mind thought that, I'm sure that there are other young adults who might think the same. So if you haven't already, definitely look into getting renter's insurance and let Lemonade help you find a policy. Thank you to Lemonade for sponsoring this video. Lemonade is a full-service carrier that offers renter's insurance from $5 a month depending on your situation. Whether you're renting an apartment, condo, or house, these policies can protect against losses to your personal property, which can include your clothes, jewelry, furniture, computers, and other electronics. You can also buy extra covers for a higher price to protect higher price items like bikes, camera equipment, musical instruments, fine art, as well as big life moment upgrades like a wedding ring. In the event of a fire, theft, or another covered event, the cost to replace all of your personal belongings can add up quickly, even if you don't own a lot. Unfortunately, many people skip renter's insurance because they don't think it's necessary. However, don't assume that the landlord's insurance covers you, even if your landlord doesn't require a policy. Lemonade protects your belongings against vandalism, theft, water damage, fire damage, and smoke damage. It even provides coverage when you're traveling, and the policy also includes liability coverage, which protects against accidents that occur in your home. All you have to do is head online, answer a few questions, and you can get a rate quote in about 90 seconds. And in addition to renter's insurance, you can get other types of insurance through Lemonade, such as car, homeowners, pet, and life. So if you're interested, you can get a quick and easy quote at lemonade.com/broken wallet, and I will include a link in the description. It's also important to understand the difference between a need and a want, and this is crucial when preparing a budget, which is something you should also have. Unfortunately, some people don't completely understand the difference between these two, so they end up overspending on their wants and then not having enough money left for needs. And just so we're clear, needs are expenses that aren't a choice, and these include housing, food, insurance, utilities, basic clothing, and minimum debt payments. Wants, on the other hand, can include subscriptions, eating out, entertainment, and miscellaneous shopping. As you create your budget, the first thing you want to do is add up all of your needs and then subtract this amount from your take-home pay. Next, set aside a percentage of the remaining money for savings and debt repayment, and from here, create a splurge or fun budget. Regardless of what you might hear, being good with finances does not have to be all work and no play, and I firmly believe in being realistic with money, because what's the point in working hard if you can never enjoy it? So you should absolutely build splurging and fun into your budget, and it's important to plan for these expenses so that you don't deal with frugal burnout or overspend on a good time. Now, as far as how much to spend on fun, there aren't really any hard or fast rules, but one recommendation that I do see often is to keep it between 5% and 10% of your take-home pay. Also, use credit, but don't rely on it. There are so many mixed opinions about credit cards. Some people love them, others hate them, but at the end of the day, getting a credit card is probably one of the easiest ways to establish a credit history at a young age, and one option is a secured credit card, which doesn't require a prior history. But it isn't enough to get a credit card. You have to be responsible with it, which includes paying your bills on time, setting a monthly spend limit, only charging what you can afford to pay in full each month, and most importantly, don't use your credit card as an emergency fund. What you want to do instead is build a cash reserve. Also, it's important to educate yourself daily about money. Money can be a complex topic, and a lot of this is not taught in schools, so most people learn on their own through trial and error. But the good news is that you don't have to make a bunch of mistakes. Google is your friend. So each day, take about 10 to 15 minutes to read a personal finance article or a blog post or watch a finance video. And not just the content on how to be frugal and money saving tips. Don't get me wrong, that information is useful, but you should also broaden your understanding and learn about investing, savings accounts, getting a mortgage, credit management, and so forth. And finally, make sure you check your credit report annually. This is so important, yet it's something that a lot of people forget to do. Every consumer is entitled to one free credit report from each of the bureaus every 12 months. So make a habit of getting your reports each year, and contrary to what you might have heard, checking your own credit doesn't hurt your score. This is one of the best ways to ensure that all information on your report is accurate and up to date so that you don't run into issues when you're ready to buy a house or car. That's all that I have for you guys today. Don't forget to like, comment, and share, and also subscribe if you like personal finance and you want to see more videos like this. I typically post every weekend, so thank you again for watching, and I'll see you in a few days.